Welcome to StokTok's deep dive into ICICI Bank Ltd. ICICI Bank is India's largest private sector bank by assets, a dominant player in retail and wholesale banking across the Indian subcontinent. As of May 1st, the stock is trading at $26.42. Over the past 52 weeks, it has ranged from a high of $34.57 down to a low of $25.08. So we're currently sitting in the lower half of that range. The Relative Strength Index, or RSI, is at 36.8, which signals neutral momentum. The 50-day moving average is at $27.73, while the 200-day moving average sits at $30.36. Price is below both, suggesting weakness in the intermediate trend. Let's work through the fundamentals, scene by scene, starting with a quick business overview. ICICI Bank earns the majority of its revenue from net interest income, the spread between what it pays on deposits and what it charges on loans, supplemented by fee income from wealth management, insurance, and transaction services. The bank operates across Indian retail lending, corporate banking, and investment banking, competing in an industry with significant scale advantages and regulatory barriers to entry. The StokTok score on this name is 56 out of 100, a hold signal. Breaking that down across 5 dimensions, valuation scores 17 out of 20, indicating the stock looks reasonably priced. Financial health scores only 7 out of 20, a yellow flag. Profitability scores 10 out of 20, suggesting efficiency concerns. Growth scores 20 out of 20. This is a strong performer in the growth category. Smart money scores just 2 out of 20, meaning institutional capital is not enthusiastically accumulating the name. Let's dig into each. Now, valuation. The question every investor has to answer: are you paying the right price? ICICI Bank trades at a price-to-earnings multiple of 15.76 times trailing 12-month earnings, with a forward price-to-earnings of 15.79 times. Essentially flat year over year, which in our view suggests the market is not pricing in significant multiple expansion despite the growth story. The PEG ratio, that's price to earnings to growth, which divides the PE by the growth rate, sits at 0.89. A PEG below 1 generally indicates the stock is trading at a discount relative to its growth rate, which is attractive. The price-to-sales ratio is 4.12 times, meaning the market values the company at just over 4 times annual revenues. The enterprise value to EBITDA multiple shows 0.00, which reflects data limitations in how banking entities report EBITDA. What we can say is that on traditional equity multiples, ICICI Bank appears reasonably valued, not stretched. Our DCF model suggests the stock is trading at a 39.4% discount to intrinsic value. That's a meaningful margin of safety, in our view, assuming our assumptions on loan growth, net interest margins, and cost inflation are correct. Wall Street analysts have a consensus mean price target of $35, with a high target of $37 and a low of $34. That's roughly a 32% upside from current levels if the consensus is right. 4 analysts cover this name, and the consensus recommendation is strong buy. Now, on the economic moat, ICICI Bank benefits from significant scale advantages. The cost to open and run a bank is enormous, which deters new entrants. The bank also enjoys switching costs, as retail customers are sticky once they establish checking and savings relationships. Regulatory licensing requirements and capital intensity further protect the incumbent position. However, the Indian banking sector is highly competitive, with state-owned banks still commanding market share and technology-driven fintech players eroding lending and payments margins. In our view, the moat is real but under pressure. Most recently, in Q2 2025, ICICI Bank reported earnings per share of $0.41, beating analyst estimates of $0.39, a modest beat. Revenue came in at $625.67 billion, which significantly missed the estimate of $2,174.51 billion. That miss warrants clarification. Banking revenues are reported in rupees and converted. The rupee-dollar exchange rate volatility and the methodology used in estimates may explain the discrepancy, but on a constant currency basis, net interest income grew. The headline metric that mattered, net income of $147.55 billion, representing a year-over-year revenue growth of 13.9%. The stock surged 2.1% after results were released after hours, suggesting the market was satisfied with the earnings quality despite the nominal revenue miss. Market sentiment around ICICI Bank leans bullish. The broader banking sector is outpacing IT and gaining market share. Positive earnings momentum is evident, and sector rotation toward financial services has provided underlying support. However, geopolitical tensions and crude oil volatility continue to create headwinds for sentiment. On valuation, the data suggests ICICI Bank is neither expensive nor cheap. It trades at a modest discount to intrinsic value, with analyst upside of about 1/3, and growth-adjusted valuation that looks reasonable relative to historical trading ranges. Moving to financial strength, how solid is the foundation? The Piotroski F-score, a 9-point checklist of balance sheet and cash flow health, comes in at 4 out of 9 for ICICI Bank. That's below the midpoint and signals moderate concern on accounting quality and financial flexibility. A score of 4 suggests mixed signals across profitability trends, asset quality, and operational efficiency. The Altman Z score, which is a bankruptcy risk model used primarily for manufacturing firms, shows 0.00. This metric is not meaningfully applicable to banks due to their unique capital structure and asset composition, so we can set this aside. What matters more for a bank is the balance sheet composition itself. ICICI Bank's cash-to-debt ratio is 1.2, meaning the company holds 1.2 units of cash for every unit of debt. That's a healthy position. The bank can cover its short-term obligations comfortably. Interest coverage, the number of times the company can cover interest expense from operating earnings, shows as not available, which is standard for banks since they don't report operating income in the traditional sense. Instead, we look at capital ratios and loan loss provisions. The debt-to-equity ratio is 0.61, indicating moderate leverage. For a bank, this level of leverage is normal and expected. Banks are inherently leveraged institutions, using deposits and debt to fund lending. The real question is whether capital ratios are adequate relative to regulatory requirements. The current ratio, another standard metric, shows 0.00, which again is not applicable to banking institutions given their liquid asset base and deposit funding model. The bottom line on financial strength. ICICI Bank is not in financial distress, but the Piotroski score of 4 suggests we should monitor asset quality, specifically non-performing loan trends, and ensure that capital ratios remain above regulatory minimums. The bank's balance sheet is more heavily leveraged than a typical industrial corporation, but that's the nature of banking. We would want to see capital ratios trending stable or improving and loan loss provisions adequate for the credit cycle. Next up, profitability. Is this business actually making money efficiently? We start with return on invested capital, or return on invested capital, which shows 0.00. Again, for banks, this metric is distorted by the nature of their balance sheet and how capital is defined. A more relevant measure for a bank is return on equity, and that comes in at 16.03%. That's solid. Return on assets is 1.98%, which reflects the fact that banks operate on thin net margins and deploy significant leverage to amplify returns on equity. The gross margin is 0.00. Operating margin is 0.00. These traditional manufacturing margins don't apply to financial services. What does apply is net margin, which is 24.3%. That means that for every dollar of revenue ICICI Bank generates, it keeps just over 24 cents as net profit. That's a respectable margin for banking, and it reflects the bank's pricing power and cost control. Free cash flow margin, the percentage of revenue that actually converts to cash available to shareholders, is 27.45%. That's exceptionally strong and suggests the bank is not only profitable, but also converting earnings into actual cash. This is a positive signal on cash generation and dividend sustainability. In Q2 2025, ICICI Bank's net margin remained robust at 24.3%, consistent with prior periods, meaning the bank is holding its efficiency despite the competitive environment. Cost-to-income ratios in Indian banking have been rising due to wage inflation and technology investment, but ICICI Bank has managed this better than peers. The verdict on profitability: ICICI Bank is efficient relative to peers in the Indian banking sector, with solid margins and excellent cash conversion. The low Piotroski score earlier warrants monitoring for any deterioration in these metrics, but the current picture is one of a profitably run business. On to growth: is this business expanding, and at what rate? Over the trailing 3 years, ICICI Bank's revenue has grown at 19.7% annually. Over the trailing 5 years, that figure is 16.3% annually. Both figures are strong for a developed banking market and suggest the bank is gaining market share from state-owned competitors and expanding its customer base and product mix. Book value per share, the accumulated earnings retained in the business, has grown at 18.2% over 3 years, which is in line with revenue growth and healthy. This alignment suggests the bank is not destroying shareholder value through poor returns on incremental capital. The dividend yield is 0.94%, which is modest but not unusual for a bank with a strong growth profile. Management tends to reinvest retained earnings rather than return them as dividends to fund the growth we see. In Q2 2025, ICICI Bank reported year-over-year revenue growth of 13.9%. A slight deceleration from some prior periods, but still solid in absolute terms. The slowdown reflects a normalizing interest rate cycle. As rates stabilize, net interest margin compression becomes a headwind, which is a factor facing all Indian banks. Management did not provide explicit forward guidance, but the consensus analyst estimate for the next earnings in July 2026 is earnings per share of $0.41, essentially flat to the prior quarter, which would imply revenue growth decelerating further in the near term as the interest rate cycle continues to normalize. That's something worth watching. The growth picture overall is one of a bank operating in a mature but still expanding market, with revenue growth in the mid to high teens, book value growth in line, and a trajectory that depends on the company's ability to maintain net interest margins and grow loan volumes through the credit cycle. Now let's talk smart money. What institutional capital is actually doing with this name? 6 top-tier investment gurus currently hold ICICI Bank as part of their portfolios, according to tracking of 13F filings. That's a respectable number but not overwhelming. Among 13F institutional filers, large money managers required to disclose holdings quarterly, only 2.8% are net buyers, meaning more than 97% are either flat or sellers on the name. That's a major red flag. It suggests that despite the fundamental case we've laid out, big money is not enthusiastically accumulating this stock. In fact, some of the most prominent holders are reducing positions. Sarah Ketterer of Causeway Capital Management, a Guru-tracked hedge fund, holds 0.20% of her portfolio in ICICI Bank and added 7.29% to her position. That's a small buy. But Poland Capital Management, another institutional heavyweight, holds just 0.02% and reduced the position by 44.77%, essentially exiting the name. That divergence is notable. One top manager is adding, another major manager is bailing. Insider ownership is 0.0%, meaning management owns essentially no stock. That's a negative signal. You generally want to see company leadership and boards holding meaningful equity, aligned with shareholder interests. Insider transactions over the last 3 months show 0 buys and 2 sells by company insiders. That's a yellow flag. When insiders are selling and not buying, it can signal they view the stock as fully valued or face near-term headwinds. The smart money picture is mixed to cautious. Guru interest is present but not enthusiastic. Institutional capital is generally exiting. Insider activity is absent on the buy side, and insider ownership is non-existent. This divergence between the fundamental case and actual smart money behavior is worth accounting for in any investment thesis. And finally, the verdict. Let's bring it all together. On valuation, the data suggests ICICI Bank is reasonably priced with a modest margin of safety embedded in the DCF, analyst upside of roughly 1/3, and growth-adjusted multiples that are not stretched. On financial strength, the Piotroski score is a concern, but the balance sheet is not in distress. We'd want to see management focus on maintaining capital ratios and watching asset quality. On profitability, ICICI Bank is running an efficient operation with 24% net margins and strong cash conversion. This is a well-managed business. On growth, the bank is expanding at high single-digit to low double-digit rates, which is respectable for its stage of market maturity, but the growth may be moderating as interest rate cycles normalize. On smart money, there's a glaring disconnect. The fundamentals look reasonable, but institutional capital is not accumulating the stock, and insiders are not buying. Q2 2025 earnings beat on the bottom line and showed revenue growth of 13.9% year-over-year, which reinforces the growth narrative. But the miss on nominal revenue guidance and the after-hours gain of only 2.1% suggests the market had already priced in much of the positive news. The overall picture: ICICI Bank is a well-run bank with solid fundamentals, reasonable valuation, and a growth story that's intact but moderating. However, the disconnect between the fundamental case and smart money behavior warrants caution. This is a hold, not a compelling accumulation opportunity, in our view. The setup is interesting, but you'd want to see institutional capital start to return and insiders demonstrate conviction before adding to positions. Everything in this video is our interpretation of publicly available data, not financial advice. Please consult a licensed financial advisor before making any investment decisions. That's the deep dive on ICICI Bank Ltd. Like and subscribe so we can keep providing you with no-nonsense, data-driven analysis of stocks. We will keep updating our videos as soon as new data that affects the stock becomes available.